But will this latest bounce have any staying power? Let's ask Max Kettner. He's HSBC's Global Research Chief Multi-Asset Strategist. Welcome back.
Thank you.
What do you think? Staying power or not?
Absolutely, I do think so. I think, we're still sort of waiting for the absolute definitive buying signal. So some of our shorter term signals are still only at sort of neutral levels. So really what we're trying to do is we're trying to absolutely nail the timing. And let's be honest, when we look at, for example, next week's retail sales data, it's pretty binary, right? If we get, for example, a little bit of a downside surprise, maybe we get another setback, and that's the absolute low then, perhaps, yeah? But if we look at a 3 to 6 month horizon, a bit of a longer term horizon through maybe just 1 or 2 weeks, then in fact, I would say, I think what you guys were just discussing before about, some of the Fed being still cool as a cucumber, I think that is exactly what we need right now, because the data, in fact, are not really warranting that kind of panic that the market has been displaying for most of this week. Even the high frequency data, we see things like the staffing index, so weekly labor market data have turned a bit higher, weekly retail sales data have turned a bit higher. So even all of that is pretty good. There's no real sign of an imminent collapse or an imminent recession.
Do you think this whole thing was an overreaction?
Absolutely. I do think so. I think when we look, for example, at what that's driven, I think really it was largely sort of what we describe as a triple whammy, where you had, essentially the Bank of Japan, this unwind of the global carry trade, where you've got a bit of rotation out of tech, out of AI, a couple of names last week during the earnings season not being as fantastic as we had all hoped for. And then, of course, you had these recession concerns and the SARM rule being triggered. This is everyone was so obsessed about. And all of that, of course, then those three things hitting in August in pretty poor liquidity conditions. So to me, I think we could be waking up in a month and sort of think, wow, that was a bad dream, but nothing more than that.
But how do you know that the unwind, if you want to call it that, of positioning relative to Japan has run its course?
Yeah, I think part of the picture that we can track is when we look at the Japanese yen and we look against sort of typical cross-asset drivers, or frankly, just against yield differentials. When we look at US against Japan rate differentials, clearly what's been happening since April, we've seen an unusual and pretty unjustified gap between the two opening up. So the yen was depreciating further, even though, the yield differential was already heading the other way around. And that gap is really starting to close almost entirely. I think as soon as that has been closed entirely, I think that's a pretty good basis for saying, hey, you know what? Now there's no more sort of big divergence there. There's no more big exuberance there. That's probably then pretty close to the end of the unwind of that carry trade.